If you master the PD raise discussed in this video, you master the market. And more specifically, you master the direction of price. Because price, evidently, we see right here, it's always heading towards a PD ray. It's our job as a trader to find out which PD ray is next. And how we know which PD ray is next, that story is also told through PD rays. So the foundation of essentially everything is PD rays. Then on top of that foundation, we can build a whole skyscraper of concepts that can help us. Now that's exactly what we're going to do in this video. And then by the end of this video, you will have mastered the direction of the market and you will be able to profit from it. In order to reach that, we're going to go over this roadmap. Number one, we're going to start off with PD rays. So the foundation of everything that we do. Number two is the trend. Number three is order flow. Number four is respect versus disrespect, which is told through candle signs and also to candle rejection. And the number five is order flow transition. So spotting reversals in the market. And number six, and that's the last one, is combining everything, how it tells you exactly what the market is about to do. We are bullish or bearish. So number one, the PD rays. Again, we mentioned that price is always heading towards a PD ray. It's our job to find out which one is next. So we need to first understand what the PD rays even are. When we talk about PD rays, it literally stands for premium and discount arrays. And those premium and discount arrays are the following. We can first sum them up and then put them into a specific category. Because the PD rays in general are, first of all, fair value gap, then you have a fair value area, and then you have a swing point. Now, if we now put them into their specific category, premium arrays are bearish fair value gaps, bearish fair value areas, and swing highs. Whereas on the other side, discount arrays are bullish fair value gaps, bullish fair value areas, and then also swing lows. Now, in order to fully understand the rest of the roadmap, we quickly need to go over what those PD rays actually are. So first of all, we have those fair value gaps, and the fair value gaps are simply that 3 candle pattern. So for example, this right here is a fair value gap. The reason why is because we have 3 candles. We have the first candle, it's whatever. The second candle is an expansion phase candle, meaning that it closes above the first candle high right there. The third candle does not trade back into the first candle high, which leaves this area right here, which is that fair value gap. Now, this is a bullish fair value gap. A bearish fair value gap would be this right here. Also that 3 candle pattern again. Now, these fair value gaps then lead to the understanding of fair value areas. Now, fair value areas can be a little bit more difficult to understand, but essentially what a fair value area is the retracement in a bullish scenario before we continue higher. Now, in order to understand that fair value area, let's first actually go over those swing points, and then we'll cycle back to the fair value area. So a swing high and a swing low is also this 3 candle pattern. Now, swing points are quite straightforward. They're also quite simple in my opinion. So for example, a swing low right here is where we see this wick in the middle sticking out at the bottom. That makes it a swing low. Because the first candle, this candle right here, is higher, and the third candle is also higher and not below this low right there. If you reverse that for a swing high, then this, for example, could potentially be a swing high, but only if the third candle right there does not reach back above this swing high. And we see it did not reach back above this high right there. So this is now, with the third candle being closed, it is also a swing high. And if we cycle back to the fair value areas, then this allows us to understand what a fair value area actually is. So for example, this right here, from the swing high towards this swing low, that is a fair value area. Now this right here, from this swing high towards this swing low, is also a fair value area that we can potentially continue higher from. And this cycle repeats. Now there's one important thing to understand when marking out a fair value area. For example, when the fair value area right here that we see is directly overlapping with a fair value gap. So the high of the fair value area right here is directly overlapping with this fair value gap. That means we mark it out at the highest point of the fair value area, which is the wick right there. Now, if the fair value area high, so the wick right there, is not exactly overlapping with a fair value gap, you move it to the body right there. So the highest body of the candle right there within the fair value area. Now, the reason why that is because if you see this wick right there, that wick already mitigates this wick right there. So the sensitive part becomes the body of the candles right there and not the wick, since it's not overlapping with fair value gap. Now, you'll notice A fair value area is essentially the same as an order block, breaker block, and a mitigation block, for if you know those things. But the theory behind it is a little bit different, and we can encapsulate all those 3 different blocks into simply one singular fair value area. Now we understand the 3 PD arrays that we have. Now we can move on to the next part of the roadmap, which is the trend. A trend in the market can be very clearly defined. Because when we talk about a bullish trend, so we are going higher, that means we are disrespecting premium arrays and we are respecting discount arrays. And when we have a bearish trend, that means we are disrespecting discount arrays and we are respecting premium arrays. Now, if we take a sentence, so let's say we are looking at a bullish trend where we are disrespecting premium arrays and we are respecting discount arrays. Now, most people leave it at that because, well, you would say that's enough, right? Well, no, because you can objectify it even more, because we know right now the definition of discount arrays and the definition of premium arrays. But we can also know the definition of respecting and the definition of disrespecting, which is exactly what we're going to touch on in the 4th step of the roadmap. So we're going to cycle back to what this trend exactly is when we arrive at number 4, disrespect versus respect. But first, in order to understand step number 4, we need to understand step number 3, which is order flow. And I've always mentioned that order flow to me is like my baby. I absolutely love order flow. The first part of order flow is essentially the same. So it's the same definition of what a trend is. As in, if we have bullish order flow, then we are disrespecting premium arrays and we are respecting discount arrays. But order flow goes a little bit more in depth because we, for example, have order flow lags. And order flow lags are the following. A bullish order flow lag starts off with a swing low right there. Then it's followed by a fair value gap, and it also has a fair value area right here within that same lag. So an order flow lag has all 3 different PD arrays in the same exact lag. Now, the reason why these order flow lags are so good, in my opinion, is because these order flow lags are very high probability to hold and push price higher. Now, then we can take it a little bit of a step further, because if we are going to define everything, what does it mean for an order flow lag to actually hold? We can define hold. And holding means that an order flow lag, for example, this order flow lag right here, we have this swing low, which is followed by this fair value gap right there as well. It's a very large order flow lag. When we retrace back into that order flow lag right here, we now create new order flow lags from it. So when we have this new order flow lag right here, then that means this previous order flow lag right there has been holding. Sometimes I also mention it as it's following through, which is the exact same definition. It's following through with a new order flow lag right there. This is important to understand because this is the first part of understanding when order flow is actually switching. If we go a little bit back in price action right here, we see that we have this order flow lag, swing low right here, followed by that fair value gap. We see that this order flow lag is actually not holding. And instead what happens is that we create this bearish order flow lag with that fair value gap and this swing high right there. Could we say that order flow at this moment in time has switched so that we are potentially bearish? No, it's 50-50 at that moment in time, because bullish order flow is failing, but bearish order flow is not holding. And why? Well, because this bearish order flow lag right here has not followed through, has not held with a new bearish order flow lag right there. So once we start to create this new bullish order flow lag right there, we can simply say, well, we are still bullish. So then what you can see is that these order flow lags are very powerful in combination with the different time frames that you have. Because what we see is that, for example, this right here is a bullish order flow lag that holds, creates a new bullish order flow lag right there, which eventually we use the swing low right there to continue higher from, where we have this new bullish order flow lag. That new bullish order flow lag creates new bullish order flow lags eventually right here, creates new bullish order flow lags, etc., etc., etc. So this order flow alone is very powerful in understanding what the direction is. But again, you need to understand the time frames as well to use it properly. Why is that? Well, what is the reason why this order flow lag right here doesn't hold? If you're stuck on the weekly time frame like we are right now, you might say, well, I have no idea. But if you zoom out a little bit, it's simply because there's a higher time frame order flow lag on the monthly time frame sitting right there. So when using order flow lags, you ideally always want to work your way down on the monthly, weekly, daily, 4 hour, 1 hour, etc. Because the higher time frame is the stronger time frame. So we are more likely to retrace back into a monthly order flow instead of a weekly order flow lag right there, holding and already continuing higher. That makes sense. So when we understand that these order flow lags are very good in giving us this direction in price already, then what can we even do with these order flow lags? Because we can take it a step further. And now we're going into step 4, where we're going to go over defining disrespect versus respect, which is done through candle signs and 2-candle rejection. It's quite simple. It's again objective. So I'm just going to tell you how it is and you will remember it and you can use it essentially. Now, like I mentioned a couple of years ago, I came up for myself with this order flow concept, but that was mainly based on fair value gaps. Because again, evidently we see when we are continuing higher, we are creating bullish fair value gaps right here and right there. And if we are going to continue lower, we create these bearish fair value gaps right there. Those fair value gaps can be turned into order flow lags. And those order flow lags then tell you a specific direction in the market. And if that's the case, then singular candles also tell you a direction in the market. Why? Well, what are these order flow lags right here on the weekly time frame? Again, on the weekly time frame, they are simply order flow lags. But if you now go up a time frame, so if we go back into the monthly time frame, they turn into almost singular candles right here. So if we take a look at the most recent monthly candle right here, and we go, for example, into the daily time frame, then what does that turn into? That turns into order flow lags. This is then how order flow turns into candle signs. And candle signs is essentially how you can understand what a singular candle is doing. So if we take a look, for example, at this candle right here on the daily time frame, we now go down time frames into, for example, the 1 hour. That singular candle is again just order flow lags right here continuing higher. And in candle signs, we can get to an understanding of 2 types of candles. Because within candle signs, you have respect candles and disrespect candles, as I like to call them. Where disrespect candles don't necessarily have very long wicks. For example, this bearish candle right there is a disrespect candle. And that means we can potentially just continue in that direction. Because on the lower time frame, that is simply bearish order flow lags that are holding to continue lower, essentially. Then on top of disrespect candles, we also have respect candles. Respect candles look something like this. Respect candles have a specific characteristic that disrespect candles don't have, and that is a long wick. A long wick either at the top or at the bottom. Now, usually these long wicks are in combination with PD rays. So for example, this long wick is coming from this swing high right there. Now, the long wick on the lower time frame, what is that? That is essentially first order flow lags going higher right here to then order flow lags going lower. So at its core, it's a reversal. It's telling us that we are respecting a PD ray. And now it's time to cycle back to the step number 2 of the roadmap, which was the trend and understanding that, which at its core, a bullish trend is what? Disrespecting premium arrays and respecting discount arrays. And now we can understand that a little bit more clearly. But in order to fully understand the definition, we still need to understand 2-candle rejection. 2-candle rejection is candle signs, and candle signs is again based on those fair value gaps and order flow lags. So it's the whole inception of fair value gaps and order flow lags, which leads to candle signs, which leads to 2-candle rejection. 2-candle rejection is knowing exactly if we are still respecting or already disrespecting a PD ray. So 2-candle rejection can be applied to every single PD ray: the fair value gap, the swing point, fair value area. And there's something that you will notice when I start marking out these PD rays. For example, we have this swing high right there, and then we can go on. We also have this bullish fair value gap, for example, sitting right there. And let's also do, for the sake of it, this swing high right there. We understand these PD rays are on the weekly time frame right here. So 2-candle rejection, you want to apply it on the same time frame or one time frame below. But if you apply it on the same time frame, so we start looking at the singular candles that sting back into the PD rays right there. And we can again understand if that PD rays is being respected or disrespected. 2-candle rejection is very objective. So when we retrace back into a PD ray, if we take this fair value gap first, then 2-candle rejection says there's 2 opportunities to still respect that PD ray. So to still create a rejection. Either the first candle stinging back into this bullish fair value gap is going to create a rejection. If that's the case, then the second candle can simply follow through and can simply hold. So again, remember, the objective of an order flow lag is to create ideally a new order flow lag as soon as possible. So to create a new fair value gap as soon as possible. If we understand that, then if the first candle right here is a rejection from this previous order flow lag, previous fair value gap, then the objective of price is to create this new expansion phase candle right here as soon as possible, to create this new fair value gap right there as soon as possible. That's what should happen. That's what makes it high probability. Now, what we see is, if we delete this fair value gap, if the first candle is not a rejection, then what can happen in two-candle rejection is that we sweep the previous candle high with the wick right there, so that respect candle, to then continue lower instead. And then the objective is, again, to create that new fair value gap as soon as possible, which in the bearish scenario right here doesn't happen. So the reason why we need to understand this is because that leaves us with a rejection high and a rejection low. So for example, when we retrace back into this bullish fair value gap right there, this first candle is a rejection right there. Okay, so this right here is the rejection low, meaning that if we are going to continue higher, we are very likely to not trade back below this rejection low to then continue higher. Reason being is because this is already the rejection according to, again, two-candle rejection. We can mark that out with red right there. And the same way, if the first candle is not the rejection, then this right here is going to be the rejection high right here from this swing high. Now here's the beauty of it, because if we go back to understanding what a trend at its core is, yes, it's a bullish trend disrespecting premium raise, respecting discount raise. Premium raise, discount raise, we understand that definition. Disrespecting, respecting, we now understand that a little bit more. But to fully understand, when we are now still respecting, for example, a discount array in the form of this bullish fair value gap, we will not run the rejection low. But if we are disrespecting, and in a bullish trend, these premium raise, for example, this swing high right there, that means we are running the rejection high. And now you might think, well, we now have two new words to define, to dissect fully. And that is a sweep versus a run. I think this right here is a beautiful example. This bearish fair value gap that we create right there, we see the first candle is not a rejection. So what we can expect is the second candle to sweep the previous candle high right there to then continue lower. What you'll notice is that sweeps are essentially the same thing as wicks. So a sweep of liquidity is where we reach above the liquidity high right there, because again, what is this previous candle high? And we see that afterwards as well. So for example, this right here becomes the rejection high from this fair value gap right there. Now, it is important to note that if we run the rejection high right there, we have now disrespected this fair value gap fully. But what do we see when we reach above this liquidity right here? We are sweeping it. And that means we are trading above it, but immediately retracing back below it right there, which leaves this wick right there as well, which will be seen on the lower time frame through those fair value gaps and order flow lags as order flow lags coming above the high, but immediately creating those bearish order flow lags as well. Now, to fully disrespect this swing high right there, we need to run it. So if we now go back to this swing high right here, because this swing high, we are running that swing high. And more specifically, look at the difference in candles, because we just have this large disrespect candle right there closing above it. But also, if we go into a little bit of the lower time frame, for example, the 4-hour right there, then we'll see right here that we are simply creating new order flow lags above this high. We're continuously creating these new bullish fair value gaps above that high right there. That tells us that we are running the high, which then eventually results in, again, like we saw on the weekly, that large disrespect candle right there closing above the swing high. Now, and since this then tells us that we are disrespecting this swing high, so that premium array, and we are respecting this discount array right there, because we are running the rejection high, but we are not running the rejection low right there. We now at its core know what a trend is. Now then, of course, you could make the argument, is this really so important to know it quite in depth? In my opinion, yes, this is quite important to understand, because this tells you exactly when to trade and what we are heading towards next as well. So again, mastering that direction, because if we skip a few candles right now and we go forward and we arrive back at the situation that we just went over, at this situation right here. We now see, for example, that this order flow lag right here is not holding. But we do see that we are still respecting, for example, this swing low right there as well, where this right here is a rejection low. So potentially we are still bullish. But at the same moment in time, of course, we still have this bearish order flow lag right here at this moment in time as well, where we are trading back into this bearish fair value gap right there. And when we trade back into this bearish fair value gap right here, we see the first candle is not a rejection, second candle is that rejection, so that creates that rejection high right there. So now we have this rejection high and we have this rejection low right there. We need to either run the rejection high right here to continue higher towards these next PD rays that we have that swing high right there, or we need to run the rejection low right there to continue lower towards the next PD rays, which is this swing low right there. This is where we now see that we climb back above the rejection high first, but we sweep it at that moment in time. And in the meantime, what are we doing when we are both respecting premium rays and we are also respecting discount rays? That will lead to a consolidation, which here, this is not where you want to get involved. You want to wait until we either disrespect this fair value gap or disrespect this swing low right there, which again is seen through those rejection highs. So right here, once we now start to climb back above this rejection high right there, and we go into a little bit of a lower time frame right there, we can see that we are now running the rejection high. And when we are running the rejection high, and we also see again respecting these discount rays, now the target becomes very clear, because we have just determined that this next weekly swing high right there is the next PD ray that we are potentially heading towards. And that leads us to step number 5, understanding the order flow transition, and arguably also a little bit of step number 6, understanding that full story of price action. So what we have just done, we have just determined that this swing high right there is our next PD ray to target. Okay, so the direction is one thing, right? Like, we can figure out that we might want to continue higher right there towards that swing high, but there's more to trading. Otherwise, we would just be analysts. Because in trading, we should also try to get involved. And that requires somewhat of an understanding how far we can retrace. So you need a stop loss, you need an entry, and you need to take profit. This is also where, again, the order flow lags come in. So from the weekly time frame right here, if we now go down into the daily time frame, and the reason why we go down a time frame is because then we can clearly get an understanding where the order flow lags are. So here we have this order flow lag right there, the most recent order flow lag. We understand that we can now get a retracement back into potentially that fair value gap, this fair value area right there, before we continue higher. So the order flow lags also tell us how far we can retrace before we then continue higher. So in theory, you could already enter right here from the daily right there, covering the order flow lag low right there and targeting eventually the high. But what you can also do is within this daily fair value gap right here and fair value area, you can now go down time frames. And this is where the order flow transition comes in. So where you can confidently say what a reversal actually is. In the past, I've mentioned a sharp turn. And a sharp turn is essentially a fair value gap in and a fair value gap out right there, and we can continue higher. Now, a sharp turn is, in my opinion, more so of a pattern, which is still overall very good and great. But the real understanding, which I've actually never shared on YouTube, is that order flow transition. So for example, we create this bearish order flow lag right there, back into the fair value area that we have. Now, we mentioned something very specific in step number 3, order flow. And that is that order flow should follow through. Meaning that if we create this bearish order flow lag right there, we at first assume that it is going to follow through with a new fair value gap to continue lower right there, because those are the rules of order flow. We should follow through. And the reason why I say should is because if we don't follow through, this tells us a lot. Because what do we see right here? If we go a little bit back in time, we currently have the 2 candle rejection right there. We have the first candle, which is a rejection right there. And since the first candle is a rejection, in theory, 2 candle rejection should right now create a new expansion phase candle right there to create a new fair value gap from this previous fair value gap. So a new order flow lag to continue lower. Now, this is not necessarily what you want to act on, because we have already determined we ideally want to look for buys. But if this then doesn't happen and we don't continue lower, this tells us exactly when we do want to act. Because when we now run the rejection high right there, what have we now done? We have now disrespected this premium array, that fair value gap towards the left, which now means that if we now create this bullish order flow lag right here, and we have this bullish order flow lag, order flow has now transitioned from bearish to bullish, and price action visually told us that objectively. So now this fair value gap right here to continue higher from it, that right there is very interesting to overall continue higher and keep on continuing higher. And that at its core is order flow transition. Now, if we go to step number 6, again, that story, then we can apply this even to lower time frames, right? Because if you now go into the 1 hour time frame, then what do we see? We see that we have this 4 hour fair value gap right there on the 1 hour time frame. We see that we initially have a sting back into that 4 hour fair value gap right there, which causes us to trade back into this 1 hour fair value gap right there. Once this 1 hour fair value gap right here holds, we disrespect this 4 hour fair value gap right there. That right there is also order flow transition, which, if you want to simplify it a little bit more, is simply one order flow lag right there holding and creating a new order flow lag right here. And when that happens, that's order flow holding. But for example, once you do get this bearish fair value gap right there against you, and we sting back into that, you take the rejection high right there and we run it right there. That right there is that fractal order flow transition right here that we can now again continue higher from. Now we arrive at step number 6, the story, and this video has gone on for quite a while, but while I'm at it, I feel like I do want to share one of my favorite trading models that I've not explicitly shared on YouTube, so not specifically mentioned. The reason why I do decide to do it right now is because other people, you may have noticed it or not, doesn't really matter, are copying us a lot. So just like Orderflow and just like Delirium, which again, I see as my babies, I absolutely love them. I feel like I should be the one sharing that to the outside world, and no one else can take that away from me. So here we go. Delirium is essentially the same exact thing that we have just done. So understanding that we are respecting the discount arrays and we are disrespecting eventually the premium arrays right there. Now, once you have figured that out, so once you have created that story of the next PD rate that we are heading towards, so we have determined it's this weekly swing high right there. And at that moment, what you want to do is you want to work your way down time frames and understand what the next order flow lag is that price can continue higher from. So already also what we have been doing. So for example, right here on the weekly, we don't have an order flow lag just yet. But if we go down to the daily, we do. And this is the order flow lag right there that we saw. Once you have determined that order flow lag right there, that's now what we can continue higher from. And that, in other words, what we have just done, figuring out that this is the target, that's the bias. Then what we are going to continue higher from, so the order flow lag right here is the narrative. The next step is understanding the context area. And in the context area, you have a context boundary and you have a context target. And what that means is once we do reach, for example, the fair value area, you could also use the overlapping fair value gap right there. That is a context boundary, meaning that once we trade back into that and once we reach it, that right there is a trigger, a boundary to now go into the lower time frame to look for an entry. Then the first opposing PD rate that we reach, which in this case, since we don't have a swing high directly there, is going to be the previous day high right there. From the fair value gap to the previous day high right there, that's your context area. And within the context area, that's where you want to look for an entry, not when we have already reached the context target. Now for a Delirium trading plan, you want to use the following time frames. If you have a monthly order flow lag, for example, that we can continue higher from, and within that monthly order flow lag, you're now starting to look for an entry, you want to pay attention to 4-hour order flow lags. And what that entry looks like, I'm going to tell you. It's constantly 3 time frames below. So from the monthly, it's the 4-hour. For the weekly, it's the 1 hour. For the daily, it's the 50 minutes. For the 4-hour, it's the 5 minute. And for the 1 hour, for example, it's the 1 minute. So since we're looking at a daily order flow lag right here that we can continue higher from, we can go into the 15 minutes, for example. And on the 15 minutes, so on your entry time frame, what you want to pay attention to is an order flow lag holding. So for example, we see this order flow lag right here, and that order flow lag has the retracement back into it and creates a new order flow lag right here, which leaves behind these fair value gaps, which eventually right here, we have a sting back into. So once you have this second order flow leg right there, that's where you now start looking for an entry, because now order flow is confirmed to continue higher. So this, for example, right there is an entry to continue higher. You can simply target a 1 to 2 overall, as long as it's ideally within the context area as well, which is that context target right there. And that means you only need a rejection from your higher time from order flow leg to then have a trade potentially play out. And that essentially at its core, it's delirium. Delirium, order flow, candle signs. Again, these are concepts that we have introduced quite some time ago on YouTube and also the MMT. Now, the biggest mistake is, first of all, thinking that all the secrets are here in this YouTube video, because that's the furthest from the truth. This is arguably, again, the tip of the iceberg that you are currently seeing. Because, for example, what we discuss in the MMT and what we're going to dive fully into in the Get Your Edge module, which is a new module coming up, is also how we can fully objectify our trading right there, but also how you can make this high probability. What makes a trade high probability? And also a lot of different trading plans to find the one that truly resonates with you. So if you're interested in that, then I would say go to the source and head over to Trading MMT. And if you do have any questions regarding that as well, then feel free to reach out to info@tradingmmt.com. Perfect. Thank you.